Hello there everybody and welcome back to another stock analysis video. Today we are going to be looking over the company Caterpillar. This company I've actually done here on the channel several months ago. In fact, I actually checked. The last time I did this was in November. And seeing that I haven't done it in a really long time, and also recommended by Wella Gray, I'm sorry if I mispronounced your name, he also wanted to know Caterpillar as well. So I figured, you know what, it's been a while. Let's do Caterpillar again. So with that said, let's get started with this analysis. Coming right into the dividend summary, guys. Caterpillar does pay a pretty good dividend. Current yield at 2.44, which ends up being $1.20 for an annual payout of $4.80. Payout ratio in regards to the net income of this dividend is 41% on the dot. However, guys, I did take a look at this payout ratio in regards to the free cash flow, and boy is it different. So you want to take a look at the payout ratio in regards to the free cash flow as well, because cash flow is what companies use to pay out a dividend. Now, the 5-year CAGR on this dividend for Caterpillar is pretty good at 7.6%. However, what isn't good, guys, is the fact that they've only grown this dividend for one consecutive year. And looking further into why this is this way is because, well, as of July 18th, 2019, Caterpillar increased their dividend to $1.03. However, they kept it the same all the way up through April 22nd, 2021. Now, this is obviously understandable because, again, COVID happened in 2020, so they probably didn't do it because they were afraid that, they couldn't afford it, especially after you guys look at the payout ratio in regards to the free cash flow. So that's probably why they did it. But nonetheless, it is understandable, and they did increase it in the latter half of 2021, and they look like they're continued to increase it ever since. Now, the ex-dividend day is actually coming up on July 19th. Payout date is on August 19th, a month later, and they pay their dividends quarterly. Now let's take a look at the spreadsheet. Ticker symbol of CAT. Market cap of $100.2 billion. PE, guys, of 15.76. Now, I don't remember what the PE was when I first analyzed this company back in November. If I had to guess, it was a lot higher, seeing that the current share price of $187.83 is actually very much down from the peak. In fact, we actually can look at it over here on the 1 year, guys. Caterpillar is down almost 12%, and on the year to date it is down 9.26%. Peak was $237.90 with a trough of $179.67. So this might actually be a pretty decent buy with a PE of 15.76. Now, looking further into this dividend and how much in dividends this company pays out every single year, well, based off of the shares outstanding that they currently have, they pay out, guys, $2.56 billion every single year. And after this dividend is paid, in regards to their 5-year average free cash flow, they're still left with $1.5 billion, which actually ends up being a payout ratio in regards to the free cash flow of 63.4%, which is significantly higher than that of the payout ratio that we saw here when it comes to the net income. So as it stands, guys, they are above my threshold of 60% when it comes to a payout ratio in regards to the free cash flow. However, 63% isn't that far off from 60, right? If this was like in the 80s or 90s, that'd be a little bit more concerned, but 63% isn't that bad as it stands. Now time to look at some fundamentals, starting of course with the net income 5 years ago of $754 million to 1 year ago, guys, of $6.5 billion, billion with a B. That is a massive increase on the 5 year of 761%. Now, very interesting, because we see a massive increase from 5 years ago to 4 years ago, going from 754 million to 6.14 billion. And also the fact that 4 years ago to 3 years ago, they remained it pretty much at around the same mark at 6.1 billion. Now, when COVID hit, they did go down to around 3 billion, but nonetheless, after that, guys, 1 year later, they recovered back up to 6.5 billion. So this net income, it's very peculiar as to why they did so little 5 years ago. However, within the past 4 years, not including, of course, the COVID numbers, because again, it's COVID related, this isn't that big of a deal for me. They've remained it pretty close at around the $6.56 billion mark, which is again really solid. Now let's take a look at the free cash flow, the most important profit metric for any company, because guys, free cash flow is what companies use to pay out a dividend, which Caterpillar does pay out a dividend, to buy back their shares, to pay down their debts, to make acquisitions, and of course just overall grow the company. So free cash flow, guys, is by far the most important profit metric because a company can do with their free cash flow pretty much any and all of these 5 things. And on top of that, this is what we use, guys, to essentially project the free cash flow into the future and then discount it back to today, so then we could know what price we should pay for a company today. So as it stands, guys, when it comes to Caterpillar, this is looking very, very good. Honestly, I was very surprised when I saw this. 5 years ago of $3.4 billion to 1 year ago of $4.7 billion. That's an increase of 40% with a 5-year average free cash flow of $4 billion. So, as it stands, guys, this is again looking fairly good. Consistently steady from 5 to 3 years ago, right? Going from 3.37 to 3.6 to 4.24. And then they had a little bit of a dip in their free cash flow 2 years ago when COVID happened. This is not surprising at all. They went down to 4.2, but then 1 year ago, guys, they shot up to 4.7. So as it stands, seeing that they are able to increase their free cash flow this consistently within the past 5 years, even with COVID, it's pretty much just telling me that the payout ratio being 63% is actually not that big of a deal, seeing that they are able to increase their cash flow pretty consistently. And lastly, taking a look at their revenue 5 years ago of $45.46 billion to 1 year ago of almost $51 billion. That is an increase in the 5 year of 12.12%. However, ironically enough, this is by far the worst one out of the 3. So it's actually fairly surprising because revenue is the one that companies tend to consistently grow. However, we can see right here that they were essentially flat from 4 to 3 years ago. They dipped when COVID, and then 1 year ago, they actually could not make it back up to what they were 3 years ago and 4 years ago. Now they are getting close, right? To $51 billion as opposed to 53.8 and 54.7, but nonetheless, they were still not able to match that or supersede that of 4 and 3 years ago, which is again fairly surprising. This is by far the one that you definitely have to keep an eye on. That, and of course the net income, but the net income is still increasing. It's just, it had a little bit of a hiccup here 2 years ago, and the anomaly was 5 years ago, but it's still consistently increasing. This one, the trend line is essentially flat. It's definitely something to keep an eye on. Now let's take a look at some balance sheet numbers. We got the total assets minus the total liabilities. By the way, guys, I do plan on adding another graph when it comes to this calculator, and I will update it for all of you guys for the one that is available for the public. Because, well, I actually found out that it might be better to add another one in order to see if they really are able to cover their debts. Because, again, companies use their cash flow to pay down their debts. And unfortunately, right now as it stands, we do not have a good way to see if a company is able to pay down their liabilities with their cash flow. So I will add that probably this weekend. So be on the lookout for that update. But nonetheless, total assets minus the total liabilities. Guys, if the company has more liabilities than assets, that could mean that when a recession hits, they could 100% go bankrupt. Now, as it stands when it comes to Caterpillar, this is actually looking fairly good. Current total assets minus liabilities is a positive $17.1 billion. And to their credit, they have been consistently increasing this within the past 5 years as well. Average total assets is around $79.55 billion. Average liabilities around $64.3 billion. And doing this difference, we get $15.24 billion. Now let's take a look at the shares outstanding, a metric that companies overall tend to fail, especially when they are within a rock and a hard place when it comes to their balance sheet and their income statement. Now, when it comes to Caterpillar, guys, they do not look like they're having that much of an issue when it comes to their fundamentals so far. Now, what does this translate into the shares outstanding? It's actually very good. 5 years ago of 597.6 million shares to today, guys, of 533.4 million shares. That is a decrease on the 5 year of almost 10.75%. And from the previous year to the current year, we are looking at 1 year ago, 535.9 million shares to today of 533.4 million shares. That is a decrease, guys, of almost 0.5%, which is again really solid. So as it stands, when it comes to share dilution, they are not diluting you guys. They are giving you a bigger ownership of the company solely just by buying back their own shares, which is again really good. And lastly, taking a look at the cash equivalents, they currently have, guys, $5.66 billion in cash, average cash of $7.42 billion. Now let's make some assumptions, low, median, high, using 3 different factors as always: revenue growth, predicted share buyback, and of course the required rate of return. Guys, I have these blank because I actually want to do them with you guys. Recently I've been doing this and I kind of like it, just so that way you guys can see exactly how I think when I make these assumptions. So for the low assumption, let's use the revenue growth on Seeking Alpha's growth tab. And as we can see here for Caterpillar, their revenue growth year over year is actually 22.5%. The revenue growth forward is 14.16%. So my job as an investor, guys, is essentially to be very conservative when it comes to these assumptions. Even the high one, even at my rosiest assumption, I still want to take into account all possible things that can go wrong with this company. So for the low assumption, guys, I'm going to say a revenue growth of 10%. For the median assumption, I'm going to say a revenue growth of 13%. And for the high assumption, I'm going to say a revenue growth of 16%. Now for the predicted share buybacks, we have the shares outstanding graph that you guys just saw, and we know that they have been decreasing their shares on the 5-year at 10.75%, which is again really good. Now, can they continue this within the next 4 years? Probably not. They'll probably slow this down. So taking this into account, I'm going to say that for the low assumption, they're going to continue to buy back shares. However, they're going to decrease it to 5%. For the median assumption, let's say that they'll do 7%, and for the high assumption, let's say that they'll do 9%. Now that we have all of these assumptions made, and of course keeping the required rate of return the same at 10%, we get some target share prices. For the low assumption, it is now $247.33. For the median assumption, it is $278.62, and for the high assumption, it is $313.25. Now we need to adjust for debt. This is why we take a look at the cash and equivalents, as well as when filling out the stock fundamentals tab on Google Spreadsheet. You need to put in, guys, the net debt, because when you add a company's net debt with their cash and equivalents, if a company has more cash than debt, then this number comes up. If a company has more debt than cash, then this number comes down. As you can see, it does come down, guys, to $197.15 for the low assumption, $227.41 for the median assumption, and $260.97 for the highest assumption. Now, on top of this target share price after debt, I also like to add a margin of safety as well of 5, 10, and 15%. And in doing so, this puts me to buy this company within the range of around $167.58 to $187.29. For the median assumption, it is $183.30 to $216.04, and for the high assumption, it is $221.83 to almost $248. Guys, the current share price is $187.83. So, as it stands, this actually might be a pretty decent buy in accordance to the target share prices and target share prices adjusting for debt, and even some of the ones with the margins of safety. Now, the one that it isn't, though, is the lowest assumption with a 10% margin of safety, as you can see right here, of essentially $177.44, and as well as the 5%, which is off by a couple cents, but this is essentially the same number, guys. I mean, it's not really that big of a deal to be a couple cents off of the current share price. So if you believe my assumptions, guys, then this actually might be a pretty decent buy as it stands, assuming that you believe that this company is going to grow based on these growth assumptions, as well as that they'll buy back shares at this rate as well. Now, these are just based off of my assumptions. You guys just saw me input all of these numbers. So everything can change if you just change some of these numbers. For example, let's say that you think that they'll do 29% when it comes to their revenue growth, and you think that they'll be doing the same amount of share buyback within the next 4 years at around 10%. Well, now it's $470, right? That's absolutely insane. I personally don't think that that will continue to happen, because the bigger a company is and the more that they grow, the harder it is for them to get bigger and to keep growing, right? So that's essentially why I'm being conservative when it comes to these numbers. So this is essentially where my share prices lie. If you do not agree with my assumptions, I have this calculator, guys, available for free, as well as a book value ratio calculator, and as well as a re-evaluation calculator as well. The reason why I'm giving out these for free is because this is not financial advice. And of course, Every investment is the present value of all future cash flow. We cannot know the future. It is impossible. I wish we knew the future, right? We can't do that. The only thing we can do is make assumptions of the future of what we know in the past. So based off of that, I highly encourage you guys to get these 3 free calculators. It's in my calculators playlist. You go into the link in the description and you make a copy and you make your own assumptions. I also have a dividend tracking sheet as well. If you guys want to have that, it is essentially what you see right here, and obviously it's blank. You guys can fill out your companies, and I also have a video on how to fill it out as well as these calculators too. So I'm giving you guys these 3 free calculators as well as a dividend tracking sheet. All I'm asking for, guys, is help me grow my channel, like, subscribe, comment, and of course share. Thank you so much for the people who comment. Thank you so much for the people who suggest companies. If you guys have any companies that you would like me to do, please tell me below in the comment section. I'm more than happy to do them, assuming that I can do them, right? I need minimum 5 years of data in order to do an analysis on them. But nonetheless, thank you all so much for subscribing. Thank you all so much for the interaction. I greatly appreciate it. Now let's move into what this dividend actually gives us based on a certain amount of income that you make throughout the year. So let's say that you make $68,703. If you buy this company solely for a dividend, at the current share price, this would buy you guys 30.48 shares if you put in 1 month's income into this company. At the current annual dividends per share of $4.80, this will get you guys an annual dividends of $146.31, quarterly dividends of $36.58, and a monthly dividend of $12.19. It's actually not too shabby. Of course, there are better ones out there, and if this company does continue to fall, then this annual dividends would actually increase, right? But as it stands, it's actually not that bad for $5,725 invested at the current share price. All in all, guys, Caterpillar is actually a company I actually considered buying. For some reason, I never did. It's probably because of the fact that I just have way too many companies already, and I just don't want to keep adding more and more and more. They do have pretty solid fundamentals, I gotta say, right? The profits are amazing. The only one that is kind of iffy, though, is the revenue, which is kind of ironic. They pretty much have their total assets and liabilities covered. They are buying back shares, which is, again, really, really solid. And overall, the company is looking fairly good from a fundamental basis. Now, on my previous video, the one I did in November, man, I was watching that back and I could definitely tell that I've learned so much just from doing analysis and looking at more companies ever since then, because I was essentially analyzing the fundamentals in a different view than what I am today. So that's just the way that I notice as to how much I've grown in analyzing companies just based on the amount I've analyzed so far. But as it stands, this company is not that bad when it comes to a fundamental basis, and if you guys like it and if it matches with your assumptions, then by all means, you should 100% invest in it if you so wish to do so. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my YouTube sites as well as a Let's Play channel. All links in the description below. So with that said, peace out. Be on the lookout for the next stock analysis video.